welcome everybody to Grid. Thank you so much for spending your evening with us. And I'm a self-proclaimed real estate nerd time and time again, so this is one of my favorite topics is taxes. So we're going to talk a little bit of taxes, a little bit of money. And as we do every time, we're going to talk a little about what is Grid. So Grid is a global real estate community built for investors by investors. So we're not gurus, we're really just a bunch of real people that like to talk about real estate and help people build generational wealth through real estate. And our mission is to connect with as many people as we can, learn from them, collaborate with them, and spend time with like-minded people, because we firmly believe that you're the average of the 5 people you spend your most time with. And if the people that you are spending your time with aren't talking about how to make you better, themselves better, and do good things for the community, you need to change your friend group. And so we welcome investors at all stages. I mean, we're about a year into this, and it's been an entire journey. So we've had folks in this room from one rental property up to undisclosed amount of rental properties with multiple layers of generational wealth. So we like to spend time with people anywhere across that journey. We don't discriminate, we welcome everybody. And so one great thing that I love about Grid is we are free to the public, and we are out to change the world one community at a time. So our future vision, this is what you're part of. We intend to have 1,000 communities across the globe with 2,000 Grid leaders, create 10,000 financially free people, 100,000 millionaires, and we'll have 1 million members. Crazy enough, since Sean and I started, we were in group number 11 1 year ago, and it's grown to 30 groups already all across the country, where we learn from, sell to, buy from, collaborate with people all across the country, and eventually we'll be across the globe. So who am I? I'm Josh Wally. I'm an associate broker from Douglas Elliman Real Estate. Off screen is my good partner Sean Morrison at Benchmark Construction. Points East LLC. What 4 other businesses? Mill Pond Painting.
You got it.
That's enough. Eastern Expediting. All right, you like to brand, right? Like you only got one business, Rook. So what do I want to accomplish with all of you? I want to learn a little bit about each of you, spend a little time with you, and learn how I can make a difference for your family. And I firmly believe if we give it away in slices, it will come back in loaves. Guest speaker tonight. So we got a little bit of a treat here. Over a year ago, I sat with Curtis and Sean, and we did a little deep dive in your office, and I knew this guy was about to change my life, and I stopped the meeting, and I said, this is a little weird, but do you mind if I record the entire thing? And about 15 minutes later, we shut it off, and I've listened to that 15-minute little off-the-cuff meeting like 10 times on my way back and forth to work, because I appreciate it. It changed my mind, and it opened a ton of doors. And so, I don't know, it's very special to have Curtis with me, because he was there in the beginning of this journey. But just to, I don't know if you know, but he's kind of a big deal, and I'm happy that he's here with us. So Curtis, would you tell us a little bit about yourself, who you are?
I'm a big deal. No.
Sure are.
No. I grew up in construction like Sean did. Went and got my undergrad in accounting, passed the CPA exam, went back to construction for a little while. Then went to law school, passed the bar exam, opened my own shop, and I do all of the above.
Super humble, no bigs. Young lady.
I'm an enrolled agent, so I have been preparing taxes with Curtis for the past 20 years now, and
you still like him?
I do. I still like him.
You're a number nerd, right? You're a number nerd?
I'm kind of a number nerd.
Sweet.
Yes.
Okay. We can be friends. Yeah, I would say the money's in math, and I hated it when I was a kid, but that's where all the good stuff is. So I usually just go around the room really quick. Tell us a little bit about yourself, where you are on your investing journey. I know who you are because you're here every time, and I love it.
Susan Lombardi, Douglas Elliman Real Estate,
You.
Josh's office in Babylon Branch. I do a lot of short sales, and I'm interested to one day be an investor myself.
Young sir.
Nicholas Fischetti. I'm actually an IT tech. My mom wanted me to come with her and learn something, so I figured I'd just learn.
Fantastic. Perfect.
Dawn Fischetti, I'm a real estate agent, Douglas Elliman,
You.
Central Suffolk office, and I don't own any properties, but I know people who do, parents, relatives and such, and I love finding ways to help them.
Fantastic. young lady.
I'm Connie Henriquez Kimball. I'm with my buddies here, Jeff Kimball. And so we are new investors, according to Sean. Confusing. And so we just bought our first house, our second house on the North Fork. And so we're learning more about the tax benefits and all that stuff. So that's why we're here tonight.
Perfect.
I'm Jeff Kimmel. I'm an attorney. My firm is Salinger, Sack, Kimmel, and Bavaro. We do personal injury and medical malpractice work. I'm a managing partner, so I manage the firm, I manage our house, and all that stuff.
Fantastic. Thank you so much for spending time with us. So I'll say, having a cursory or surface understanding of taxes, because I'm not an expert, and that's why these folks are here. Because typically, I know enough to get in trouble, right? To make a crazy idea, and then I just send it off to these guys. I'm like, am I going to go to jail? And then if they say, no, you're fine, then we move forward with it. But understanding the tax code is a really important way that us as realtors can make a difference for people's lives. And we're going to dive into a couple little pieces. We're going to scratch the surface, and then feel free to move up really close to them and grill them as soon as we shut the camera off. But before we get going, especially because we have attorneys in the house, please don't sue me, okay? So I am not giving legal advice, I'm not giving tax advice, I'm just giving ideas and suggestions for you to take to those folks that have one or many fancy licenses that are they're educated enough and trained to validate these crazy things that we come up with. Also, by being here, you are giving me your consent to film or photograph you. So the biggest thing that changed my mind, I'm a big fan of like one-liners, and a very, very smart gentleman I met through Grid who owns a lot of properties, and he just says the same thing over and over again. He goes, it's not only what you make, it's what you keep. And that was really profound for me. And he said, managing tax implications is the other half of the investing equation. Because when we talk investing, everybody goes, how much money did you make? How much money did you make, right? But then, really, it's all fantastic. But at the end of the year, you have a fantastic year, and all of a sudden our gut drops, and we go, ugh, now I got to come clean with the man, right? So there's a couple of things that we can use, a couple tools that we can use here to help folks mitigate their tax implications. So make a bunch of money and keep a bunch of money, really, is what we're talking about. And I think everybody's heard at one point, we call the 1031 tax-deferred exchange. So 1031 refers to the section 1031 of the tax code. And so if you plan to hold and invest real estate for a number of years, right, and as a realtor, I love when people buy and sell, because that's when we make money as a realtor. But as I got deeper into my investing skill set, I understood why people held their property forever, right? And I stopped getting so bad that they don't sell, because most of the time it doesn't really make sense to sell. There's another underlying strategy that we can implement. 1031 tax-deferred exchange is one of the tools that we use to offset our tax gain or defer our tax gain and use the government's money to continue our path to developing generational wealth. Again, I can't say it. I'm pretty sure there's 4 or 5 slides in here where it says this is not legal or tax advice. This is not legal or tax advice. So based on section 1031, the IRS, the Starker or like-kind exchange conversation, it's a technique for deferring taxes on real estate. And you can do it possibly forever, even though it's a little anticlimactic at the end. And we'll get to that.
You gotta die.
You gotta die. Basically, if you don't want to ever pay taxes, you gotta die. But this is how the generationally wealthy, uber wealthy people pass money on to the next generation, and they do it without paying taxes on it. Really smart. So the regular way of investing, right? How do we do when we invest, right? We flip. Everybody hears about flip. So we buy the property, we improve it, we sell it for a bunch of money. What happens right there?
You pay taxes.
Pay taxes, right? You have a giant tax implication in the end, right? My father and my stepmom now, they were flippers and smart people, but they did a bunch of flips and made a bunch of money. I'm like, you gotta put that money somewhere. You're just gonna be like, no, we're gonna be okay. Like 4 months later, they go, we just filed our taxes. You were right. We paid a gigantic amount. They go, these tax things suck. I go, yeah, there's another side of it. So 1031 is a common way that you will see that, right? So 1031 exchange process allows you to take money made on a real estate investment and not pay that tax, but actually keep that money that would go to taxes and move it into another property. So we call it like rolling. You keep rolling the proceeds from one property into another. But there's a whole bunch of rules to it, right, Curtis?
Lots of rules.
Okay, so it's not, everybody goes, just do a 1031. Is it that easy?
No,
It's
it's
not
very
that-
difficult.
Okay.
Not really designed for a flipper either, correct?
No, yeah, although the rule says that you have to have the intent to hold it, so you theoretically could make the argument that you always intended to rent it and then suddenly decide not to, but then you'll be asking for an audit. So generally, you got to hold it for a year or more. That's kind of the rule of thumb.
Got it. And so one thing we get, I hear a couple common misconceptions. So one, they go, I sold a vacation house. I'm going to 1031 into this new primary residence.
So
No,
subject to a few safe harbor rules, you cannot do it with anything that you use personally.
perfect, right? So these are all investment property moves. So you can't have lived in it. I think
There's a rule, not to get too technical,
Yes.
but if it's under 14 days that you've used it and you've rented it for 14 days or more, you theoretically can do it with vacation or rental / vacation property, but really, really got to be careful.
Okay. So one big thing, there are some big rules, right? And like everything in the world,
There's exceptions.
to the rules. So there's a couple little things. So without jumping down into the weeds, and we're telling folks, they're like, I'm going to sell this vacation property and I'm going to make a bunch of money, but I'm going to 1031 into something I'm going to use myself. No go, right?
No.
Let them know. As we said before, it's typically for long-term stuff, right? So there's a couple of restrictions that are attached to a 1031 that make it, I think if you're going to roll properties quickly one over another, it makes it almost impractical to really use that strategy. Am I correct?
Yeah, I mean, it might be cost prohibitive. I mean, the exchange fees are not terribly expensive. The one we're doing now, I think, is about $3,000, and the property is worth probably about
1.6.
1.6. So it's not terribly expensive. But the bigger problem is your bargaining power because you're under a time crunch. So you have to make sure that your buyer is capable of buying. You have to identify the property within a certain time frame. It's 45 days. And then you have to close within 180. And in New York and Suffolk can be difficult,
It can be challenging, right?
depending upon what you're buying.
One big thing I hear people go, well, I'm going to take a little bit of my money now, and I'll do a 1031 with the other portion. Can you do that?
Well, you could, but it might not make the most sense. Any money that you pull out of the property is considered boot, and that boot is taxable.
Got it. So we hear a lot, like if you want to defer all of that tax, you got to roll up.
You got to roll equal or up.
All right, the government.
If
is
you
saying-
roll down, you're going to pay taxes on the difference between what you had and what you have.
Got it. So the government really wants you. The intent here is to incentivize keeping that money flowing into the economy.
Correct.
And when we say equal or greater value or equal or greater risk, right? So we see like kind exchange. And when they're talking about like kind, they mean like financial, like kind of risk profile.
Real estate for real estate.
Got it.
Investment property for investment property, business property for investment property, not personal property for anything.
And you can go house to land to commercial, back to house to land,
Yep.
right?
Yep.
Got it. So don't get stuck.
And a portion of it can include some of the personal property inside. So you can actually include some of the personal property. If you're buying, let's say you're buying a barn and there's a tractor there, and the whole thing is rolled up in one transaction, as long as the tractor isn't exceeding 15% of the total price, you can roll in some of the personal property.
Farm boys, all right, we do some 1031 as some farmland, right? Move some equipment on it. All right, perfect. So yeah, big thing here. If you sell a property for 500, you can do a 1031 into another property. That property must be the purchase property must be $500,000 or greater to be able to defer all those tax proceeds. And quick off the top of your head, capital gains tax rate, short term.
Fed is, short term is ordinary rates.
Okay.
So, and this wouldn't, 1031 theoretically anything it's more than a year, so you're long term anyway.
Okay.
and that's 15% generally, and then your ordinary for the state. So I usually say rule of thumb is around 20%.
20%. Okay, sounds good. So you're saving yourself 20% by doing a 1031. So like we said, you can exchange down. You can do, cash purchase a lesser property than you sold. However, whatever that diff is, you're going to pay 20% tax rate on whatever that difference is. So it depends sometimes, because you can get a little tight when you're in a negotiating situation, that timeline, and there is extensions to that timeline, am I correct? Not at all.
There's a few extensions that were around during the pandemic.
Okay.
They don't exist
They're gone
anymore.
anymore. Okay, got it. That's the 45, when we're talking about extension, so you say.
Well, there's a 5-day rule, but that's getting into the weeds.
Right. So we have the 45, 180. Those are two important numbers
Yep.
to know when you're doing the 1031. Can you tell me about those?
So the 45 days, you have to identify the target. You generally identify 3 targets. I always tell my clients, although they don't listen all the time, make one of the targets a 1031 fund, which we can get into later. Yeah, so you get into those funds. That gives you a third option in case your others fail, and then you have 180 days to close.
Got it. Okay, we have to be careful which DST you identify, right? Because if they're multiples, that can burn up all 3.
That's right.
Okay. Gets a little fun, right? That's why I know enough to get into trouble. Oh my God, just drop it into a DST. But you got to know, I'm a nerd, but you got to get the uber nerds in here because you can really put yourself into
Uber
a bad
nerds.
spot.
We're
Right?
uber nerds.
Look, that's a good spot to be. I will be a real estate nerd all day. So can I do a 1031 exchange myself?
You shouldn't. You can't. You shouldn't even use an attorney to hold the escrow. You should really use a facilitator.
We say qualified intermediary. So there are folks that are around that's all they do for a living is they do 1031 exchanges. So they follow the rules, they know the timelines. The big thing is you can't touch that money. If you get that money, right, it's in your control, it's taxable.
Right, and if your attorney holds onto the money for too long, it technically can be considered a distribution, and then the whole 1031 will be broken.
Man, those attorneys, right? Every time. All right. So, big thing, I like the way they put it. Basically, the IRS doesn't trust you to manage your stuff, right? And they go, this is all cool and all, but you really got to get somebody else in here who understands this process and is an expert in moving these funds back and forth. So it is a great tool, right, to offset paying taxes, but it takes a little bit of work, and you got to know the right players. So, oh yeah, so spoiler alert, yes. Of course, we know 1031. We have intermediaries that we've had in this room before that we've done business with. My advice is the attorney that you select in your process to purchase and sell your home should also be using the 1031 intermediary that they suggest because they have that great working relationship. And remember, the cohesiveness of your team can either float or sink your real estate transaction. Did I get that right?
You got it.
Okay. So I guess really what's the point of the 1031 really is to
Avoid taxes.
sounds great, right?
Mm-hmm.
What do I do every day? I wake up in the morning, figure out how to make money, try to avoid getting sued, try to not pay taxes. Like that's my entire day. So 1031 is a big part. Well, what do I do at the end? What's my exit strategy from a 1031?
Die.
So tell me.
I'm sorry.
Right.
Well, look,
Well,
if
there's a couple ways,
you
right?
sell the property, you have 2 issues to worry about.
Okay.
One is your capital gains tax on your profit.
Right.
The other is the recapture of the depreciation that you've been pushing off for years.
Okay.
So, using some round numbers, if you purchase a property at $500,000, depreciate it down to $300,000, and sell it for $1 million, you have $500,000 of gain that's taxable at the capital gains rate. The $200,000 that you depreciated is recaptured. Am I right? Section 1245.
It's
Yes.
recaptured. So then
It's recaptured at ordinary rates.
Okay.
So
Then that depends on the tax bracket.
that depends on the taxpayer's bracket at the time, but it is certainly more than 20% if you're in this business.
It's terrible news.
So, and the problem is if your depreciation recapture is large, that in and of itself will push you up to the higher brackets because of that additional income. So it's not the greatest idea to sell property that you've depreciated completely unless you have to,
Got it.
or unless you're going to use the money for something else.
Kind of sounds like a government conspiracy. Am I on it? No? Okay, sorry, moving on. Right, so here's the spoiler. So what a lot of folks do, at the end, they'll plan these things years and years out. And so the point is that you trade up into this giant, enormous asset. And I think as people that do this throughout their life, they typically end up in a flagship commercial building.
Yeah.
Right?
Yeah.
That pays good cash flow dividends.
That's right.
So then they take this gigantic property that they bought with the government money, then they transfer this cash flowing free chunk of real estate to the next generation.
That's correct.
Who blows it, basically.
Pretty
right
much.
away. Pretty
Pretty
much,
much.
right? Most of the time, right?
Most of the
80% of wealth.
Or they all fight over
Right?
it and
Yeah.
it gets ripped
So
apart.
specifically, when that person passes and the next generation inherits that property, how does it clean up that 1031 for that next?
So when you
generation?
leave property to somebody, either through a will or through a trust or a couple other ways to do it, they get what's called a stepped-up basis in the asset. So they get to pick two dates: the date of death or 6 months after. So if you bought a piece of property for $500,000, you depreciated it down to zero, it's worth $1 million. You pass away, you have one child, they take that property and their basis is $1 million.
So it all starts over fresh.
It all starts over fresh.
That's a wonderful thing, right?
Yeah.
Yeah.
That's it. So that's the game of
Did
real
they
estate.
talk about getting rid of that? Is that ever talked about?
Getting rid of the property?
No, getting rid of the 1031. That
Yes.
whole
Or the,
thing.
Yeah, they're talking about it all the time.
well, the stepped up basis.
No, the stepped up, I haven't heard anything about the stepped up basis, but the 1031s they got rid of in 2017, all like kind exchanges for personal property. So you can't do car for car, you can't do any sort of personal property. It's just real property.
Okay.
And then there was a lot of wrangling over what's considered real property. In New York, technically co-ops are,
Real
they're really stock, but the federal government recently came out with some guidance that the state law controls. So anything real estate, including co-ops, would suffice.
Yeah, because co-ops is always a gray area, right?
Yep.
Shares in a corporation, it gives you
The right,
monetary
yeah,
lease
lease
to
to,
occupy.
yep.
Wild stuff, right? Stay away from co-ops, they're weird.
yeah, agreed.
That's one, too.
Very much agreed.
Right. So we jumped into it a little bit, but we're going to go into the next section, and this can get a little heady. So let's slow it down. But we talked about it a lot, which was depreciation. So we talked about taking your asset, you have a secondary home, right? So now you have this big, beautiful vehicle that you can use to offset your income, which would be through the wonderful, I say, is
But
like,
now if we live in it though, that's not an investment property?
How, you mean living it permanently?
Or as a second home?
No. No.
but if they rented it,
Well, you could rent a portion of it. It could be partially an investment property. That would not work for a 1031.
no, but for depreciation.
Depreciation, it would probably not be a wise idea because at some point you might consider making it your primary. And if you're sitting there for 2 years, you can get the $500,000 exclusion. So why depreciate?
Right? So it's all part of that strategy. But depreciation is, I don't know, is a big piece. Again, I told you, it's only 2 of 5. There's 3 more coming. Dude, this is not tax advice. So we're going to talk about these things. You can see just right there, like how complicated it can really get. And depending on the strategy that you employ, really depends on where you are in your life and what your plans are. So you may be, most folks, anybody here hear of depreciation before? Anybody familiar with that? I know you are, but you don't count. A little bit, okay. Right, so there's normal depreciation, then there's also accelerated depreciation, which is wild. So we're gonna kind of get into those pieces, right? So a property held for investment, not your personal residence or short-term flip, held for less than 1 year. The IRS assumed the building itself will lose value over time due to wear and tear, weathering, or etc. So in other words, it depreciates. Big piece to note. The improvement, the structure starts to fall apart, just like we do, right? We all, as we age, we fall apart. I do not.
So get crazy, okay?
Yeah, like I look pretty good, right? But I don't look as good as I did, right? But one big thing is land doesn't depreciate. So land just is what it is. So like we were kind of talking in condos.
Have that conversation with your homeowner's insurance people.
What's
When
that?
they try to insure your
Replacement costs.
Yeah.
Yeah.
Right? You're like, they're like,
Yeah.
the house worth $1 billion. But okay, but the real estate's worth this much and can't go away, right?
True. Right? So, and because a building is losing value over time, right, it's depreciating, it's falling apart, the IRS allows you to take that, right, as a loss against other gains, right?
Sort of.
Okay.
So it's really, when you, and this is a common problem that we see. Somebody comes in and says, I made $100,000 this year. And I bought a building for $100,000, so I have no tax liability. And that's not how it works.
Got
Your expense, what you pay for that building, the IRS says you cannot deduct the entire cost because you're going to reap the benefit over the X amount of years. For residential rental, it's 27 and a half. Commercial, it's 39.6?
Yeah,
30, something like that. So the IRS basically says that that asset that you bought, you shouldn't expense it now. You need to expense it over time. And you need to expense it over 27 and a half years. Cost segregation is taking the rules of the IRS and turning the residential rental property into its components. Because a portion of it is residential rental, but also a portion of it is appliances, which is 5-year property. Also a portion of it is landscaping and fixtures, permanent fixtures like driveways and whatnot. That's 15 years. So the IRS is basically saying, we're saying this is 27 and a half years. You can't expense all of this at once. You have to break it up over 27 and a half years. Cost segregation is saying, well, it's not all residential rental property. There's other things inside here that make up the total purchase price, and those things we want to accelerate. So what you're doing is you're taking the 27 and a half years, a portion of it is 27 and a half years. The other stuff you're kind of segregating out and bunching up, so you take those deductions up front.
Front loading
Accelerating
those.
that's right.
Got it. Yeah. So you nailed it. It says on the slide, 27 and a half years. Right?
27.
So normal straight line, we call it, right? Straight line
Straight
depreciation is 27 and a half years. So just explain, if I buy $500,000 house,
You want to go with this?
land is worth.
It's
we won't
easier.
get too deep.
Let's do it this way. You got
Yeah.
$500,000 house, but the actual property is $275,000.
Okay.
So that means you have $2,750. Is that right? If my math is right, $2,750 per year that you can take as an expense against your income that you're producing
every single year.
every
From
single
that
year
asset or
So-
in general?
from that asset.
But it's an
And
expense
right.
to your rental income, or so if you're rent.
1099 income too?
no,
Just asking for a friend.
no.
So just
So,
income that comes from.
You're right. So
property.
each rental goes on a Schedule E. And each Schedule E will calculate your income from the rental, your expenses in terms of your interest payments, insurance, taxes, and then one of the items is depreciation. So it reduces your rental income, which ultimately reduces your bottom line.
Taxable income. Got it. Okay, sounds good. Is that prorated?
Prorated?
Like within a year?
Well, you have a limit on your deductibility for passive income of $3,000 per year, so you get to carry over those losses into years that you might have a higher income.
Got it. I follow all of that stuff. So the way they kind of talked about in here was you can deduct about 3.636 of the building's value every year, right? So you can take, right, $3,636 deduction in this particular scenario over 27 years. So it just kind of allows you to not pay as much taxes on the rental income that's coming in from that property. Make sense? Okay, I got that right. So, perfect. So,
Here's one, like, so the advanced depreciation and they broke up to like 100%, is that what this is?
that's
right
what
here?
we're heading
Okay,
into.
I didn't
Yep.
know if we're skipping
So,
right there.
27 and a half years is a really long time. I'm only 27 years old, my entire lifetime. So that's a long time. And like I say, I don't have time for that. Or let's just say I had a really good year, right? Or that property we made right?
Yeah.
Good money from that particular property. Or even you buy commercial, right? A lot of folks are coming in, the year they buy that big giant commercial property, they're gonna do a cost segregation analysis, right? And so, like we were kind of alluding to, different components of your property some parts of your property fall apart more quickly than others, right? So this little analysis is really kind of taking chunks of this value and assigning it to different spots, and you're taking it all in one tax year.
Taking it all in shorter tax
Shorter
years.
tax years.
So
Okay,
some
tell
of
me
it
about
will
that.
be, some of it will be running on a 5-year timeline. Some of it will be running a 7, 12, 10, depending on the type of the property.
Got it.
So carpeting, for example, is 5 years. Fixtures like computer equipment, that's 7 years.
Okay.
So we could go on.
Yeah, please, yeah.
So you're breaking it all up into its components.
Got it. So tell me about, this can get a little heady, and we'll break off the video and dissect it a little bit. But what I wanted to talk about is the 80, 60, 40, 20, right? Like your 100% accelerated depreciation. Isn't there a cascading amount of depreciation that I can take in the tax code right now?
What do you mean?
Like a Trump era thing, so where you can take all of our gains and accelerate them into.
Well, there's there's called a 179 deduction, which is taking, depending upon what property, whether it qualifies.
Yeah, you can
You
write
might-
off the entire amount in year one,
Right.
all 100% in year one.
There's some
Of my-
of your expenses if it's qualified property.
Of my expenses or.
Yeah, so for example, if you have a building and you put in an HVAC system, that's qualifying 179 property, you can deduct the entire amount in year one.
Got it, okay, instead of.
Right, parking lot improvements are not qualified 179 property, so that you'd have to depreciate over 15 years.
God,
So,
at least it's not super complicated.
Yeah, yes,
Oh,
exactly.
and groupies, right? So, but I think the big thing here I really wanted to impress upon is like, you have to have a team like you guys involved in this entire piece, because we probably don't even know it. We could be leaving a ton of money on the table every
Right.
single year.
right, you're playing with the time value of money. Money is better in your pocket than in the government's pocket.
And you always have to look at it both ways too, like what tax bracket am I going to be in this year versus what tax bracket am I going to be in next year? Would it benefit me to write off this entire amount right now? Or would it benefit me to spread this over the next 5 years, 10 years, or whatnot? You have to kind of look at it that way as well.
Yeah, and whether you're going to do major improvements that will provide additional depreciation. And of course, if you create massive losses, you're going to be rolling those over for year over year. So yeah, I mean, it's not one size fits all. You certainly should look at the whole picture.
Man, I really, that's what you're for.
That's what she's for.
Yeah. We're talking about. So, yeah, big thing to really understand is that there's a couple of different opportunities for, for either avoiding taxes right out of the gate, then if we're going to get them, reducing our exposure. So, of 1031 tax deferred exchange, I mean, depreciation, pretty much everybody that owns a rental property is whacking depreciation, right?
Should.
When does the cost segregation analysis make sense?
I think it always makes sense. Whether or not, if you're going to sell the property relatively quickly, my suggestion is it's probably not a good idea, because between the cost of doing that, preparing the returns, accelerating your depreciation, maybe you're going to create a net operating loss that's going to carry forward anyway. Probably not the greatest idea, but if you're going to hold the property for more than 5 years, it's probably a good consideration. If you're going to plan on rolling it in to another property with an equal or greater value, it's always a good idea.
Say that one more time.
So if you're going to
Say that to me like I'm
1031,
an 8-year-old.
if you're going to 1031 it, right?
Yeah.
When you roll over to that new 1031, you're going to have additional basis in that property because you're rolling up your profit into that, and you're going to depreciate that as well. So you're going to have the depreciation that you had on the original building plus the depreciation you're going to have on the new building. You better accelerate the front end as much as possible so that you can use that other depreciation, accelerate that, and catch your next couple of years. do it again and again and again, and you'll continually beat the clock.
So that sounds like, Curtis, I'm gonna dump this property at some point this year, and I'm gonna roll it up into another one. You go, great, that sounds good, Josh. I know a good broker, you should call him. But before we
Yeah.
do that,
Sue, I think.
right, right, so before we do that, we should depreciate the hell out of this thing this year, right? And then dump it into the next property.
Yeah, but it's also a cost benefit. It's cost benefit,
Okay.
yeah.
I'm just trying to put that into
Yeah.
stuff
Yeah.
that I would have.
Yeah, and yeah, in the world of taxes, is pay less now and think about it later.
I'm all for it.
No, I mean, the reality is you don't know what's going to happen with the code.
Right.
You don't know what they're going to do with the 1031s. You don't even know what they're going to do with this. This came about because of a case with the hospital. The hospital attempted to break their building down, and the hospital has a lot of personal property and stuff. And they accelerated the depreciation. The IRS challenged them, and this is the seminal case that created cost segregation. So you don't know what rulings are going to come down. You don't know what they're going to do to the tax code down the road. So bird in your hand is always a smart move.
Which is the exact slide, right? So tax laws can always change, but while they're available,
Yeah, yeah, you like-
right, take it
oh,
and run,
good.
right? It's the perfect segue right into the right. So I would say, like, yeah, utilize them as best you possibly can. But the point here for us realtors, I've had more referral-based business. So there's a couple, like, there's only a few things that people care about. Like, they care about if you can teach them how to make more money. They care about if you can help them save more money or teach them something they didn't know. And most of the time, when I'm sitting with the customer, we're kind of like asking these questions. Do you rent it? Do you live in it? How long? What kind of improvements did you do to it? Like, all these types of things. All of a sudden, my hat kind of changes a little bit. I'm not just like a realtor who wants to stick a sign in the ground and sell it as fast as possible, but I've become a part of their like financial life and their future. And we go on this little bit of journey. When I bring in, they go, you know what? I say a couple things, but there's a guy who's a lot smarter. I want to give you this little plan. I'm going to send it by Curtis. He's going to tell me I got like 3 out of 5 things correct, and he's going to finish this, and we're going to make a difference for your life. And when you do that, you make customers for life. And this is really how, through this type of collaboration, just the basic understanding of these things, that we can change people's life. We're going to jump into shotgun, self-directed IRA.
Yes, my favorite.
Boom! All right,
Love
I
it.
didn't know this coming
Yes.
in. I love it. We're going to
It's
nerd
my
out.
favorite.
All right. So I don't know. I heard the founder of Grid. I took this class, and so one of the sections when I took the Grid AI certification course, which every agent in the room should take. He talked a lot about this self-directed IRA thing, right? And he was like, I bought a property out of my self-directed IRA, and he fixed it up, rented it, and it turns out he sold it back to the renter on a private mortgage, which then gets paid back into his self-directed IRA. He did all this crazy stuff tax-free. And he's like, if you don't have a self-directed IRA, you're a chump. I was like, okay, fine. So I started one. And now I don't know what I'm going to do with it. But I have one, so I'm in the cool club. But now Curtis broke me up. There is like 10 levels to this thing that I can do. I mean, I can't do much because I just broke into I used to be a 100-aire for a really long time. So I just broke into the 1,000-aire level. So, kind of a big deal, but I can't do too much with it. But I started it, right? And it's going to happen. So tell me why you like the what the hell is an IRA?
Individual retirement account.
Okay. Then what the hell?
You're really quizzing me. Okay.
You're like
Okay.
holding a mirror up, right? And so what is a self-directed IRA?
Okay, so I think people in general got frustrated that they would put money into a retirement account and some fund manager would be playing with their money and they would show them 10% on the downside. So they decided that they wanted a little bit more control, so they started what's called a self-directed IRA, which is essentially you managing your own retirement funds, investing how you want to invest, and all of that money grows tax-free until you start taking it.
Okay. So what can I invest in? Quick.
Anything.
Don't turn around. Anything.
Real estate.
Right, so you can do
Yes.
real estate, stocks, bonds, gold, crypto, right? You can
Right.
lend out of it.
That's probably the most common thing we see.
Okay. Why is that?
Because when you buy property with a self-directed IRA, you really have to be hands-off. You
Okay.
can't go in there with your hammer and fix it up.
You,
Sean.
I got rid of my hammer.
You can't personally guarantee any loans. So if you wanted to get funding to buy something because your IRA didn't have enough to buy it, you can't personally guarantee anything. You can't personally benefit from it. You can't have indirect family members benefit from it. And if they do, then it's considered a full distribution and you will pay the 10% penalty plus taxes plus an additional penalty for fooling the IRS.
That sounds pretty heavy.
Yeah,
right?
it's not a good idea.
So-
But so you have to be careful. That's why a lot of people use it for lending because that's completely removed. They send the money out and they can either take that self-directed IRA and lend it out directly, or they can take that self-directed IRA and dump it into a self-directed IRA LLC and use that LLC to invest in property or to lend.
Unbelievable, blew my mind. I didn't even know, like an hour ago, I'm like, what the shit is a self-directed LLC? I didn't even know that existed. So one big thing, easy breezy is you can start your self-directed IRA like overnight. And I started, what I use, equity trust.
Equity trust, big
Right?
one.
Boom.
Yeah,
I don't
very
know. They
big
were
one.
like, you gotta use equity trust. I'm like,
Yeah.
sure. I don't even know what I'm looking at. But I started with there. So big thing for folks that want to lend like hard money, right? They can lend in and out of this
Do it all the time.
self-directed IRA and let that
Yep.
bad boy grow, right?
That's right.
And I'm gonna show my 90%.
But you can't put your own money with it. So if somebody, let's say you were lending out $100,000 and you only had 50 in your self-directed IRA, you cannot put your own 50 into it.
Got it. Okay.
But you can lend with other people. So
So
Sean
you-
could put up to 50. And you could put up to 50 from your
out of my
self-directed.
self-directed IRA, right? And we can pool that together.
Correct. But all the interest gets payable to your self-directed IRA. And when the money is paid back, it goes all back into your self-directed IRA.
Fantastic. So one big piece is, I don't know, like my mother's got a big IRA account and I don't really know too much about it. All I know is she's always pissed. She's like, these MFers and I'm pulling my money out. And one big thing, like we lend a lot of hard money back and forth, which even leaving it just in the pool for them to reinvest, like we're getting what, at least 8-9% on the very cheap end. Right?
Oh, that'd be cheap.
Yeah, cheap. That's cheap money. So
I'll take it.
you relend it twice. How dare you? Yeah. As soon as he jumped at something, you gotta watch out. Right? And you missed something. So self-directed IRA. So the big piece is they are a little complex to kind of manage if you're not just straight lending out of it, right? If you're buying stuff in and out of it,
Yeah.
because all that money has to go back and forth. But like equity trust, like you have a 1031 intermediary, they have self-directed custodians.
Custodians, yeah.
Okay, tell me what does a custodian do? They clean it up?
They basically act as like a fidelity where your money is. And
Pretend I didn't know what fidelity meant.
so like an investment account, like an investment house.
Got
They hold your self-directed IRA, and when you want to lend it, usually they act as a vetting agency. So when we're lending for people that are self-directed IRA owners, we send all of our loan documents to the custodian.
Okay.
They review it and make sure that they feel it's a sound investment, not from whether this is a good borrower, but whether or not the documents are enforceable.
Okay.
And they make sure that there's nothing in the documents that could end up disqualifying it. And then they will wire us the money to fund the loan. They have to sign the satisfaction, so on and so forth. So they are really technically the signer for you.
Got it. Okay, sounds good. How often, I would say, I guess if I'm going to start, where do I start with the self-directed IRA? Just get right on equity trust? Throw some
Yeah,
bucks in
equity trust, we use them. There's a couple other ones, they're very difficult to deal with.
Okay.
But in terms of dealing with real estate, equity trust is probably our best.
Probably the best one. And there is a traditional and a Roth?
There's a Roth, but the Roth is after tax money. So you're going to pay taxes on it, but then it grows tax-free. So,
I can open both?
yeah, sure.
Can I use both of mine to lend on the same project?
That's a tough question.
Yes, I
I would, off the top of my head, say no, but I would have to look at
I
that.
don't know. I just made
That's a
it
good
up.
question.
Right? What the hell?
It's a very
right?
good
I
question.
don't know. Right. So I think that's a big piece. I think right now, because I was playing golf with a financial advisor, and he was like, "What did you do?" I'm like, "I did a self-directed A." He goes, "Well, you can't buy property unless you buy the whole thing." I'm like, "But I can lend it." And he was like, "That's a really good point." I was like, "What are you
I'd say we
He
do
thought it was
more
tough.
lending through self-directed IRAs than anything. We do have a couple guys that use the self-directed IRA to buy business property, but you cannot
property?
use that yourself. So you can't buy a rental property and stay in there. That'll disqualify you immediately.
Okay. And like you have to be incredibly careful, like when I'm
Really, really careful.
talking through case studies, like
Yeah.
even if you want to like go in and pay that plumber to fix the leaky sink,
Yeah, not
you
a good
can't.
idea.
Like that
No.
can wreck the entire thing.
Right.
So
I mean, nobody's standing there watching you, but I
So,
wouldn't
you're
do
saying
it.
that if I bought a commercial building, can
Mm-hmm.
one of my companies lease that building?
No,
No, none of my companies could do that.
no.
Okay.
damn.
Do we get into
It's like a
front loading that
personal
IRA?
benefit.
Is that part of these questions?
No.
So
Go ahead, ask away. Yeah.
can you front load your IRA and how does that work?
What do you mean front
So
loaded?
obviously you had a traditional 401k, you could transfer it into it, right?
Yeah, there's limits. You probably know this a lot better than I do. There's limits on what you can contribute to an IRA. It functions just like the traditional IRA in terms of your pre-tax income going into it.
Yeah. So that's like
So there are
you
some-
take a loan out of it
Right.
and you wanted to maximize that. Do you know the maximum what you can put in right now, or how does that?
It depends on your age because there's some catch-up figures. I want to say it's like, what is it, like 17 or 18,000?
Yeah, that sounds
somewhere around there.
Yeah, it's around
Yeah,
17.
per year.
Yeah.
Per
So
year.
if you've never had a self-directed IRA, on year one, can you only dump 17,000 in there, or can
There's a limit, but depending on your age, you can do catch-up contributions. So don't ask me what those numbers are right now.
If you bought a building or a rental property, the income from that
Has to
building
go
or
back to the
has to
IRA.
go back into the self-directed
Yeah,
IRA.
so when we lend out the money for clients that are self-directed IRAs, the payment letters and everything that we submit with the loan documents the payments have to go directly to the IRA. You can't even collect for them. Even the act of collecting could be deemed a distribution.
Like taking the rent, like collecting the rent.
No, like
If you could
collecting your
possibly collect interest
collecting
if
your
you did,
interest,
that's
putting it in
probably-
your account, and then thinking you can send it over to has to skip over you and go directly to them.
Okay, it's like hands off. Okay, got it. So shocker, there are some restrictions to this whole piece. Like one, it says you can't use furniture you currently own in an IRA-owned rental property. That was one disqualifier that folks bought an Airbnb and then brought their own furniture into that Airbnb, disqualified it. So you have to be really, really careful when you're using this as an investment strategy. So I'm gonna lend. Like I will never do anything other than lending. I'm already bald, but you
Yeah.
would think like I had nothing to lose, but it's so stressful.
A lot of people try to get away with it all the time. All the time.
It just seems
All the time.
wildly
It's foolish.
risky for me.
Yeah, foolish.
I don't know. I just think like lending in the space that we do, you can make such a great return.
Yep.
Why risk it?
Yeah, and if you're going to buy a piece of rental property, you get somebody to manage it for you.
Right.
It has to be a hands-off investment. Let's put it that way.
Got it.
So you can't manage it either, you have to hire a third party.
No.
manager.
Correct.
Third party.
Yeah.
Yep.
It has to be like 100% passive.
Right. And now for people that buy rental properties, we set up an LLC, and the self-directed IRA dumps the money into the LLC. The LLC then hires a manager, which cannot be you, and that manager manages the LLC and makes sure that the rents are collected and all, so on and so forth.
Absolutely. Wow. Big deal. Wow. Okay. So one big thing, if you have a bunch of friends that are all really smart and they all got self-directed IRAs, we can all pool our money to buy a joint
Yes.
investment property.
Absolutely. And we've done joint lending where, we have 6 or 7 lenders that all have a few dollars to throw in on the transaction and you do a combined mortgage.
Fantastic. Unbelievable. That's a really crazy tool. So if you got a couple extra bucks this year and you're floating around, I know there's a maximum to contributions for
Right.
Is that 17,000 or is it
Yeah, I'd have
also
to look
16?
somewhere around
All
there.
right, anyway, so there are, but you can roll the traditional into a self-directed. Traditional IRA can get rolled in.
Yep.
So if you got some folks.
Tax-free rollover.
Yeah.
Tax-free rollover, right? So we got some folks, if you got an IRA floating around there from an old job or whatnot, and you're into the grid community, get it out of there, get it lending, and get a decent return on it. So, big thing is you can take your, yeah, go.
So if 9% or 8% is cheap, what is the going rate for lending hard money?
Right now, we're seeing mostly 12%. It's been that way for a while. The more experienced guys that are doing 30 or 40 flips a year, they're probably down around 8 or 9. But then they're paying some points and some other fees that are typically associated with it. But from the lending end, with private money, I don't tell my guys to go under 12%.
Good return, right?
It's a short, the length of time can vary, but it's.
We generally don't do less than, do more than 2 years. Have to be really special. Generally, we do 1 year. We've done some very short-term financing. We've done 6 months, 3 months, 9 months.
Most of that
Generally a
is paid
year.
up front, right?
What's that?
The interest is paid up front because it's so short term.
There are some lenders, like Loan Funder is a big lender. Some of the hedge funds will take interest reserves, so they'll take 3 months up front. That happened a lot in the pandemic when everybody was scared. And at the most I've seen is 2 months over the last couple months, so it's going back to normal. The more risky, the more you want in interest reserves. But if you're a savvy investor, you don't want any of your cash sitting in somebody else's bank, so you resist it. And that's where the fight goes.
So have somebody on your term. So these little things. So are we going to leave here tax experts? No. But we need you to understand that these things come about. And when we're out there helping people buy and sell real estate, or you're thinking about, hey, when you're sitting with your accountant and he goes, you got to lose some money. You got to get some money going. Go back and remember these different tools to either offset, or reduce, or completely avoid paying taxes. So any parting words that you want to leave with the group on any of these topics?
No, I think everything is a case-by-case basis and what your goals are in the future. And obviously you don't want to spend any money that you don't have to.
Right. And I think the big undertone here is like, you don't really need an attorney or an accountant. You can do all this stuff by yourself.
All of it by yourself.
All of it by yourself. So you heard him. He committed to it.
The one thing that I would say is if you are ever looking to do like some type of 1031 exchange where you're looking to sell an investment property and buy another one and looking to do that exchange, is to go find a professional intermediary that will help you facilitate the transaction, because if you don't do that right away, then you could sell this property, go buy another property, and think that you are
we had a lot of that.
able to do a
We have
1031
a
exchange,
lot.
and you're not.
Yes.
And then it's completely
We probably
completely
get
off the
that
table and
more than anything.
Is
We
there
have
any fixing that for someone when that happens?
No.
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 Oh, I can't tell you how many people call me up and say I'm going to 1031 this house that I sold.
It's already gone.
Okay.
They already
Tell me how you
collected
do
money.
that.
That's
Because
great.
Once you collect the money,
It's over.
once you collect the money and it's in your possession, the
over.
game is over.
Yeah.
Like you can't do it anymore.
You have to
So,
think. You have to think in advance.
Yeah.
But I think that's with any of this stuff. If you're not thinking ahead, and you can only plan so much, and then life gets in the way.
Sure.
But you do your best at planning. You take your best guess. Always, in the world of taxes, it's pay less now and deal with what the consequences are later in terms of what the IRS does with their code, because they change it all the time. I mean, when Trump got in, I had people walking into my office with MAGA hats celebrating how little they're going to pay in taxes. And as they walked out, the hat was in their hand because it was not that scenario. So you do your best to guess at what they're going to do, but you got to make the right moves for yourself at this point.
Anything coming down the pike that you think we should be aware of?
I think interest rates are going to soften a little.
No, yeah.
I got a few questions. So like a new investor, just getting started, whether it's a realtor, someone involved, what do they start with? They need to open up an LLC, or what's the direction of a new investor starting? Where's their pathway to start working at?
I personally like the LLC. I think the LLC is the easiest vehicle to manage and has the least amount of pitfalls. with keeping your corporate formalities together and least expensive to operate going forward. That would be my first step. And I would do all of the groundwork to get the bank account together, get the LLC published, get that in place. I would get a set of books. I think that's probably the biggest problem that we have with new businesses is they have no idea of their costs. They have no record keeping. They have no way of analyzing what they have or what they don't have. And that 99% of the time sinks them. I mean, how many clients do we have?
What is the average cost to set up an LLC?
So it's not that expensive except for the publishing. So I charge $600. That includes everything except for publishing. The publishing in Suffolk County is about $400 to $450. Nassau County, I think, is about $350. I think the city is well over $1,000. But using a round number, $1,100 does pretty much everything, including the operating agreement, which is your most important document.
Realtor, new investor, step one, open up an LLC. You can start funding that with your income, right? Now, what does that happen to someone who's starting to go out to invest in real estate or going? Can you explain what happens to them with their taxes at that point and the separation with the LLC? What does that do, or is there a benefit there?
So it depends on how many people are doing it. So if you're a single member LLC, the beauty of a single member LLC is that you don't have to file a separate return. You file a 1040, it's on your Schedule C, so you don't have to file a separate return, you don't have to file a separate payroll for any of your distributions. It's a very easy, cheap vehicle to run. If you have two people, the default is a partnership, so you'd have to file a separate return. And the one real beauty of a LLC is at any point in time you can make the election to be treated as an S corp for tax purposes, and that might become helpful to avoid some of your self-employment tax that would attach for self-employed income.
So for real estate investors, people that do it, step one, open up an LLC.
Yeah.
Start funding that, and then that is your pathway to start then buying real estate.
Right, and no knowledgeable lender will lend to an individual in New York. We do some in Oklahoma, some, I think we were talking about it before, we do some out of state. I'm less concerned lending to an individual out of state than I am in state because the foreclosure laws in New York are brutal. So if you're a lender and you're going to lend to somebody, make sure that they are not an individual and that they're not holding the property for a dwelling purpose. So.
Great stuff. Anybody have any questions for Curtis before we shut the video off and then we talk about questionably legal stuff? No? All right, fair enough.
Okay.